In this complete guide to smart money and ICT concepts, you will learn how to define market structure, mark swing highs and swing lows, and understand how buy-side and sell-side liquidity drive price from one level to another. We will break down equal highs and equal lows, fair value gaps, order blocks, discount and premium, and refine execution with optimal trade entry using Fibonacci. This might be the only video you need to finally understand how price really moves using smart money concepts and ICT. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before going any further, we need a clear way to define direction, because this is one of the biggest reasons why traders constantly misread market structure. Most traders believe every retracement automatically represents a real pullback, but in reality, price action is built on three different types of movement: impulse, corrective, and continuation. Each of these movements is formed through internal candlestick structures. Now let us take a closer look at each component in detail. Impulse movements represent strong directional moves that align with the prevailing trend. Within an impulse phase, price moves with strength and conviction, often creating clear bullish or bearish trends. This stage is typically driven by strong market sentiment, where either buyers or sellers are clearly in control. For instance, if we look at a bullish sequence of candles, we can observe that price forms a series of smaller candlestick-based impulse and corrective movements that collectively push price higher until a swing high is reached. From a structural perspective, it is important to interpret these internal bullish formations as a single unified bullish impulse leg. The reason for this is that price has not yet taken out or meaningfully swept the liquidity resting below any of the previous minor internal lows. Even so, when viewed at the candlestick level, this movement is classified as an impulse. Following this, we observe a valid pullback, where price breaks and closes below the most recent bullish candle, forming a bearish candle that represents a minor correction. After that, another impulsive movement appears, which we define as a minor continuation. As we can see, price continues to follow this pattern repeatedly until it reaches the swing high, and in this example forms a deeper corrective phase. With that established, we can now shift our focus to corrective movement. A corrective move is essentially a temporary counter-trend phase that moves against the primary direction of price. Therefore, within a bullish market structure, a correction is confirmed when price breaks below an internal pullback or internal low, or when it sweeps the liquidity associated with that level through a wick. In this scenario, the correction is represented by a sequence of three bearish candles, showing the price has moved lower and taken the liquidity below the most recent pullback low. Shortly after, price resumes its upward movement and eventually breaks above the most recent swing high. This progression leads us to classify the move as a continuation. In a similar example, within the second candle sequence, we again observe price forming a series of smaller internal impulse and corrective movements pushing upward until it reaches a brief pause and then retraces lower through another set of three bearish candles. Since price has not broken the lowest point of any internal pullback or internal low, nor retraced to at least the 0.382 Fibonacci level, which is an important rule within the ComLucro framework, and has also failed to sweep the liquidity below these levels in this sequence, we cannot classify this as a valid corrective movement. Therefore, this price action should be interpreted as a single impulsive move without any correction. These concepts also apply to bearish market conditions. Now, once you understand that not every retracement is a real pullback, the next question becomes even more important. How do we actually confirm when structure is truly breaking instead of simply creating another liquidity sweep or temporary retracement? When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. In classical terms, it prints higher highs and higher lows. Inside this type of trend, what we call a pullback is simply a retracement of price before continuation. On the ComLucro channel, pullback and retracement mean the same thing. Every time a structural level is broken, a fresh demand zone is formed, and that zone often becomes the reference area where the pullback reacts. A break of structure is only considered valid when a candle clearly breaks through and closes above the level. A wick extending above the high shows that buyers managed to push price higher, but it also signals rejection back into the range. From a pullback perspective, this type of move often represents liquidity being taken, not a real retracement. Many traders confuse these wicks and liquidity grabs with pullbacks, but they are not the same thing. When price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent higher low. This higher low is the key reference for identifying a healthy pullback. As long as price holds above this area, the bullish bias remains intact, and the retracement is considered corrective. When price pulls back into this zone and respects it, we classify that move as a valid pullback. If a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. A change in character takes place when price breaks and closes below this higher low. When that happens, the move is no longer a pullback or a retracement. Buyer control is being challenged, and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. However, this creates another major problem for most traders. Even after understanding break of structure and change of character, many traders still struggle to identify which pullbacks are truly valid and which ones are simply temporary reactions inside the trend. Because not every swing high or swing low should be treated with the same level of importance. The first concept we will cover is how to separate major swings from minor swings, because this distinction is essential to identify valid pullbacks. Not every swing high or swing low defines a retracement. In an uptrend, major swing lows are the levels that matter, because they are the zones from which breaks of structure originate. This level represents the starting point of the impulsive move after a previous high is taken, and it defines where a pullback is allowed to retrace without invalidating the trend. A change of character happens when price breaks and closes below this specific level. When that occurs, the move is no longer a pullback or a retracement. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. These minor breaks often happen during pullbacks and should not be mistaken for a change in direction. Now here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. Until that happens, a retracement cannot be properly defined. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it with conviction. Only after that confirmation can we label a swing as major. For that reason, this level becomes the reference point for pullbacks, while the remaining swings are treated as minor reactions. A break below a minor swing low still signals a temporary loss of bullish strength, but not a reversal. In some situations, such as a reversal liquidity sweep coming from a higher time frame key level, a short trade may be considered targeting the major swing low. This is because price often reacts when it taps into that level. However, this type of trade goes against the primary trend and carries higher risk, which is why most of the time these moves are better understood as part of a pullback rather than a trend change. The second criterion is the fair value gap. In the ComLucro framework, fair value gaps help us determine the quality of a pullback. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure. often linked to institutional activity. When a pullback retraces into a demand zone that created a fair value gap, we expect a reaction because price is rebalancing an imbalance, not reversing the trend. For this reason, demand zones that include fair value gaps are treated as major reference points for pullbacks, while zones without imbalances are considered minor. When price breaks below a major swing that created an imbalance, this signals a meaningful shift in momentum. At that point, the move is no longer a pullback or a retracement, and it may point to a potential reversal. The same logic applies in bearish scenarios, where pullbacks react into supply zones that contain imbalances. Now let us move to the third and final criterion that helps us define a valid pullback: the depth of the retracement. In the ComLucro framework, pullback and retracement mean the same thing. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles. But this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum depth is not achieved, this retracement is considered invalid. As a result, this move is not classified as a real pullback. Instead of being treated as an impulse followed by a correction, the next push higher is read as a continuation of the same impulsive leg. In other words, what looks like a pullback on the chart is actually just part of the impulse, not a completed retracement. This leads us to a key rule in the ComLucro framework. For a pullback or retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing or a valid pullback. But structure does not exist on its own. It is built from individual price movements on the chart. This brings us to the next concept. What are swing points, and how do they relate to liquidity? Swing points are defined as either swing highs or swing lows. To identify a swing point, we use a three-candle structure. In a swing high, the candle in the middle has a higher high than the candle to the left and a higher high than the candle to the right. In a swing low, the candle in the middle has a lower low than the candle to the left and a lower low than the candle to the right. Swing points are important because of how traders place their orders. Many retail traders set their stop orders just above swing highs or just below swing lows. As a result, liquidity tends to accumulate around these areas. In a long trade, both the stop loss and the take profit are sell orders. In a short trade, both the stop loss and the take profit are buy orders. This relationship between order flow and trade direction leads directly to the concepts of buy-side liquidity and sell-side liquidity. Above a swing high, there is a large concentration of buy stop orders. These orders come from traders who are short and must buy to exit their positions, as well as from traders who want to enter long positions if price moves above the high. In ICT terms, this area is defined as buy-side liquidity. Below a swing low, there is a large concentration of sell stop orders. These orders come from traders who are long and must sell to exit their positions, as well as from traders who want to enter short positions if price moves below the low. In ICT terms, this area is defined as sell-side liquidity. The identification of buy-side and sell-side liquidity levels is an important component of the ICT method and helps explain how price moves and where reactions are more likely to occur. Let's now move to a real price chart and look at practical examples of buy-side and sell-side liquidity. On this 5-minute chart of the mini S&P, price is currently forming a low. At this stage, this is a potential swing low because the candle to the left has a higher low. If the next candle also produces a higher low, this candle will be confirmed as a swing low, which represents a point of sell-side liquidity. Moving forward one candle, we can see that price does form a higher low. With that confirmation, this level can now be classified as a swing low. While focusing on this swing low, we can also identify the potential formation of a swing high on this candle. This is because the candle to the left has a lower high. If the next candle produces a lower high as well, this level will be confirmed as a swing high, representing buy-side liquidity. Moving one candle forward, we can see that this condition is met. As a result, this level can now be marked as a confirmed swing high and a clear point of buy-side liquidity. At this point, we also have the potential for another swing low. If the next candle produces a higher low, this level would be confirmed as a new swing low. Moving forward one candle, we can see that this does not happen. Instead, the new candle forms a lower low. This new candle now becomes a potential candidate for a swing low because it has a higher low to its left. On the following candle, we can see that a higher low is formed, confirming a new swing low, so we can go ahead and mark it. Over the next two candles, price takes out the previous swing high and then returns to test it from the other side as support. After that, during the next four candles, price continues to form higher highs and higher lows. Eventually, price produces a candle with a lower high, which confirms the previous high as a swing high or buy-side liquidity, and we can go ahead and mark it. On the next candle, price continues moving to the downside. Identifying swing points is a simple process, but it is important to practice it in replay mode or in real time. With repetition, this becomes second nature when marking swing points on live price charts. But identifying swing highs and swing lows is only the first step. The next question is why price is drawn to these levels in the first place. This leads us directly to one of the most important concepts in the smart money framework. So, trader, what is liquidity and how does it actually behave in the market? To answer that, we need to approach it from a practical perspective, focusing on how smart money interacts with liquidity in real trading conditions. Before moving into patterns and execution, it is important to understand what these concepts mean on the chart and how they influence price behavior. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap. Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional, it is essential. These zones, where orders are concentrated, reveal how the market is likely to behave and help you avoid unnecessary losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let us break both down in a practical way. Dynamic liquidity relates to the forces that drive price movement. In simple terms, it reflects how price flows through structure. To visualize this, think of a typical market swing with a defined high and a low. These highs and lows represent external liquidity. External liquidity refers to the liquidity resting beyond key swing points. On the other hand, the fair value gaps within that range represent internal liquidity. Price is constantly moving between these two types. In practice, the market cycles between internal and external liquidity, moving from one to the other in a continuous flow. Looking at this schematic figure, we can see a rally wave moving upward, sweeping the external liquidity above the previous high. After that, price shifts toward internal liquidity, represented by a fair value gap, to rebalance inefficiencies left behind. From there, price transitions again toward external liquidity. In essence, the market moves from internal to external liquidity, then back again. Once external liquidity is taken, price often seeks balance by returning to internal liquidity, filling the most recent gaps. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Static liquidity can be identified in several recurring areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within or around order blocks. It is also present around support and resistance levels, Fibonacci retracement zones, and near the body and wicks of daily candles. When you consistently recognize these zones, you begin to understand how strongly they influence price direction. Ignoring them often leads to unnecessary losses. Some of these areas attract more attention than others, especially those widely recognized by traders, which leads to a concentration of stop losses and pending orders, increasing the probability that price will move toward them to capture liquidity. Among these static liquidity zones, some formations stand out because they naturally attract large clusters of stop orders. This brings us to a very important distinction inside liquidity. So, what are equal highs, equal lows, and old highs and lows, and why do they matter? When we start marking swing points on real price charts, one important pattern quickly becomes clear. Some swing highs and swing lows tend to form close to each other, while others stand out on their own. This distinction allows us to classify highs and lows into two main categories. Equal highs and equal lows are formed when multiple swing points appear at roughly the same price area. To identify equal highs, we look for two or more swing highs that cluster near the same level. In this chart, 3 swing highs form in the same area, creating a clear example of equal highs. The same principle applies to equal lows. When 2 or more swing lows cluster together around the same price zone, they form equal lows. In this example, 3 swing lows align closely, indicating a buildup of equal lows. It is important to understand that equal highs and equal lows do not need to be perfectly aligned at the exact same price. What matters is the clustering of swing points within the same general area, which often signals a concentration of liquidity. Old highs and old lows are different. These are swing highs or swing lows that stand out because they are isolated from surrounding price action. They represent previous extremes that price has not revisited for some time. In the example of an old low, price trades below the level without closing below it, and then starts to move higher. This behavior highlights how price can trigger liquidity below an old low without accepting value beneath it. This idea is central not only to ICT concepts, but also to the broader understanding of market manipulation. Price often moves into these isolated highs or lows to trigger resting orders and induce retail traders to one side of the market before reversing. Understanding the difference between equal highs and lows and old highs and old lows helps traders better identify where liquidity is likely to be located and how price is more likely to behave around these areas. Beyond equal highs and equal lows and old highs and old lows, there are other key highs and lows that traders should be aware of on any price chart. These include the previous week high and low, the previous day high and low, session highs and lows, and intraday time frame highs and lows. These levels often act as natural areas of liquidity and help explain where price is more likely to react or seek stops. But once liquidity is taken, price does not move randomly. It often leaves behind clear signs of imbalance as it expands away from those levels. To understand that behavior, we need to look at another key concept. What is a fair value gap in the ICT method, and how does it help explain price inefficiencies? A fair value gap is a 3-candle pattern that reveals an imbalance in price delivery, creating a gap between the shadows of the first and third candles. Let us first look at the bullish fair value gap, often referred to as BC. BC stands for buy-side imbalance and sell-side inefficiency. A bullish fair value gap forms when the upper shadow of the first candle does not overlap with the lower shadow of the third candle, leaving a clear gap between the two. To make this clearer, let us compare 2 price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle, which creates a fair value gap. On the right, the upper shadow of the first candle overlaps with the lower shadow of the third candle. The bearish fair value gap is commonly called SIBI, which stands for sell-side imbalance and buy-side inefficiency. A bearish fair value gap forms when the lower shadow of the first candle does not overlap with the upper shadow of the third candle, again creating a gap between the two. Let us make the same comparison for bearish structures. On the left, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, resulting in a bearish fair value gap. On the right, the lower shadow of the first candle overlaps with the upper shadow of the third candle, which means there is no fair value gap present. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. Let us now move from theory into practice and observe some real examples of fair value gaps, volume imbalances, and gaps, starting with a very simple case. We begin with this 1-hour chart of the dollar index. By moving one candle into the future, we can identify the formation of a fair value gap, since the upper shadow of this candle does not overlap with the lower shadow of the previous candle. It is common for price to return to a fair value gap before continuing in its primary direction, although this is not the only way fair value gaps can be used. As price continues to develop, moving one more candle forward reveals an important reaction. Price trades into the fair value gap and then immediately reverses to the upside, continuing its main movement. Notice that if the lower shadow of the next candle does not overlap with the upper shadow of this candle, a new fair value gap is created. In the following candle, this is exactly what happens, resulting in the formation of another fair value gap. Looking closely at the next candle sequence, we can observe an inside bar formation that does not enter the most recent fair value gap. In the candle that follows, price trades into the fair value gap and closes above it, clearly reacting to that zone in a similar way to the previous fair value gap. After this reaction, price resumes its upward movement for several more candles. If we shift our focus slightly forward in time, one additional candle reveals the formation of a gap. As shown on the chart, this gap can be marked in the same way as the fair value gaps. The principle remains the same. This is an area that price can later return to from the opposite direction, and in some cases, we can also observe inversions. In the very next candle, price reacts to the gap in a similar manner to how it reacted to the earlier fair value gaps, and then continues moving higher. It is also worth noting that the current candle is reacting to a fair value gap that formed immediately after the upward gap. Staying with the dollar index, but now shifting to the 4-hour chart, we can see a clear example of a volume imbalance. There is a gap between the close of the previous candle and the open of the current candle, yet there is trading activity within that area, which characterizes a volume imbalance. Over the next few candles, we can see how this volume imbalance holds price, and eventually the market begins to rise from that level. These imbalances often appear during strong institutional moves, where large positions enter the market and displace price aggressively. In many cases, price will return to these fair value gaps and react from them, respecting the imbalance left behind by the initial move. However, the market does not always respect these zones. Sometimes, the same imbalance that once acted as support or resistance can fail, and when that happens, the role of that fair value gap can completely change. This behavior leads to what is known as an inversion fair value gap. So what exactly is an inversion fair value gap? An inversion, also called an inversed FVG, occurs when a previously identified fair value gap fails and price invalidates it. For instance, imagine a bullish imbalance that creates a clear gap on your chart. As price retraces back into that area, the expectation is a continuation to the upside. However, if the following candles close decisively below the gap, fully violating it, the market has disrespected that level, and this failure forms the inversion. Now, let us understand the psychology behind the inversion FVG. The appearance of an inversion fair value gap is often an early indication that momentum is shifting. It reveals that the side responsible for creating the original imbalance has lost control. This change in strength can signal a potential reversal in direction. From basic price action principles, we know that after a breakout, previous support can become resistance, and previous resistance can become support. The same principle applies to fair value gaps. When a bullish fair value gap that once acted as a demand area is broken to the downside, it transforms into a supply zone. As a result, we can anticipate a possible rejection from that inversion FVG toward the downside. So how can we determine whether a fair value gap will hold or become an inversion? When trading fair value gaps, what we want to observe is price returning to the zone and respecting its midpoint, which often leads to a continuation higher. If instead price trades into the area and clearly violates that midpoint, we can anticipate further downside, with candles closing below the fair value gap and forming an inversion. To mark the midpoint manually, simply measure the range of the gap from its low to its high and identify the 50% level directly on your chart without relying on any indicator. Now, there is an important detail to understand. Fair value gaps are considered one-time use. Once price has reacted to an FVG and the market has already delivered a move from it, we no longer treat that same gap as a fresh trading opportunity. If price later breaks through it, we do not classify that as an inversion FVG. When searching for a true inversion, we want to see a sharp shift in momentum that fully disrespects the gap from the start. This brings us to the question, fair value gap or inversion fair value gap? Which one is superior? In reality, neither is better than the other. Both can be highly profitable when applied under the right conditions. They represent different types of setups, each with its own advantages and limitations. In general terms, the inversion behaves more like a reversal strategy, while the standard FVG aligns with trend continuation. For that reason, inversion setups often offer greater risk to reward potential. That said, fair value gaps appear more frequently on the chart, whereas identifying a clean inversion FVG that meets all your criteria can be more challenging. In addition, once you identify a valid inversion fair value gap, you typically do not require extra confirmation to execute the trade. Fair value gaps help reveal where price delivery becomes inefficient and where the market may later rebalance. But imbalance alone does not always explain where strong institutional reactions originate. To understand that, we need to look at another key concept that shows where large market participants may have entered the market. This brings us to the concept of the order block and how we identify a valid one on the chart. So, How can we identify a valid order block on the chart? An order block represents a specific area on the chart where a large amount of capital entered the market, usually from big banks or major institutions, often referred to as smart money. Because these participants operate with significant size, their activity tends to produce strong and visible price movements. When price accelerates sharply away from a particular level, like in this example, it often signals that institutional orders were placed there. Moves of this magnitude require heavy buying or selling pressure, and the zone where those orders were executed is what we call an order block. In general, order blocks fall into two main categories. Bullish order blocks are created by aggressive buying activity, while bearish order blocks are created by strong selling pressure. Once an order block has been clearly identified, it often becomes an area of interest because price has a tendency to revisit and react from that zone. It is common to see price return to the order block and then respond with a bounce or continuation. In this example, entering at the order block would have produced a favorable move, clearly illustrating how price can react around these areas. At this point, you might be wondering whether order blocks are the same thing as support and resistance. While both concepts are used to identify important price levels, they are not identical, and there are key differences between how they function and how they are defined. The first difference lies in how each one forms. Order blocks are identified based on strong and impulsive price movement away from a specific area. When price expands aggressively from a level, that area can be marked as an order block. Support and resistance, on the other hand, require visible reactions over time. If price rejects a level once and then rejects it again later, that repeated reaction allows us to define a support or resistance level. Another important distinction is the way these levels are drawn on the chart. Order blocks are usually marked as broader zones or areas, reflecting the range where orders were executed. Support and resistance levels are most often drawn as single lines. Even when they are drawn as zones, they tend to be much thinner and more precise compared to the wider zones used for order blocks. A third difference relates to how often price can interact with these levels. Order blocks are generally considered a one-time use. Once price returns to and touches an order block, it is no longer treated as valid. Support and resistance levels, in contrast, can be tested and respected multiple times before they lose their significance. Even though order blocks and support and resistance are different concepts, they can complement each other effectively. When an order block aligns with a support or resistance level, this creates what is known as confluence. Areas of confluence tend to carry more weight, as price has a higher probability of reacting when multiple factors point to the same zone. Before we can work with valid order blocks, we first need to understand how to correctly identify them. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, no such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. Understanding how valid order blocks form helps us identify where institutional activity may have entered the market. But not every order block holds. Sometimes, an order block fails and price breaks through it, completely changing the role of that level on the chart. This type of behavior leads us to the concept of a breaker block. So, what is the definition of a breaker block? A breaker block is a previously failed order block that transforms into a key supply or demand zone on the price chart. This happens when an order block is broken in the opposite direction, shifting its role from supply to demand or from demand to supply. In practice, a breaker block helps mitigate positions and often becomes an area where traders add to their positions. There is also an important principle to keep in mind. Whenever price breaks through a key demand or supply zone without showing respect, that zone automatically shifts its characteristic. A supply zone becomes demand, and a demand zone becomes supply. The same principle applies to order blocks. The market may ignore the supply or demand of an order block for several reasons, such as shifts in market structure, overvalued or oversold conditions, interaction with higher time frame key areas, major economic news releases, or other fundamental drivers. When a valid demand order block fails to reject the price and the market breaks through it to the downside, it turns into a supply level known as a breaker block. In this situation, we expect the price to reject that zone and continue pushing lower. Now, let us look at the psychology behind the breaker block and understand how it works. Imagine a bullish break of structure forming above the last high with inefficiency. This movement creates a valid order block tied to that break of structure, giving traders a reason to look for long entries. However, if the price later shifts market structure by pushing and closing below the most recent low, the directional bias flips to bearish. When this happens, the original demand level loses its strength and turns into a supply level as the price breaks through the order block to the downside. The psychology behind the breaker block is straightforward. Traders who went long from the original order block now find themselves trapped. They wait for price to return to break even so they can exit without taking a loss. When many long positions close in the same zone, a surge of sell orders enters the market, creating strong downward momentum. At the same time, retail traders often see the previous structure shift as a trend line breakout. They expect the price to pull back for confirmation, which leads them to look for short setups at the retest area, also known as the breaker block. Many traders will short this zone because they view it as a key supply area. Combined, these actions turn the breaker block into a clearly defined supply zone with a high probability of generating short opportunities and driving price reversals. One more point to note is that breaker blocks tend to be most effective when the market is trending strongly in either direction with shallow pullbacks, and when price is not respecting premium or discount supply and demand levels along the way. Now let us move to the next topic and look at how breaker blocks are identified from a candlestick perspective. In a bullish scenario, a candlestick-based breaker block appears when an area fails to reject the price. This is represented by the last selling candle that forms just before a strong upside move. That candle usually breaks below or sweeps the liquidity of the lowest point of the previous candle. In a bullish diagram, we would highlight this red candle as the breaker block because it is the final bearish candle before price launches into a sharp upward movement after sweeping the previous low. A similar idea applies in the second candle sequence. Here, the breaker block is the last small bullish candle that forms right before another sharp upside move, breaking below or sweeping the liquidity of the previous candle's low. These same principles hold true in bearish markets as well. It is also important to remember that these concepts work across different time frames and on any price action-based chart. Make sure to follow the video closely until the end. In the next section, we will explore the criteria and rules for identifying valid breaker blocks and review the scenarios that turn a breaker block into a high probability entry area for strong trading setups. To identify valid breaker blocks and use them effectively, we need to consider several criteria and rules. The first point is the clearing of buy-side or sell-side liquidity. For a breaker block to be valid, the price must take out a clear area of liquidity before forming a market structure shift. Here is an important pro tip. When identifying a valid order block, the price must break and close above or below the recent swing high or low to confirm a proper break of structure. However, this condition does not apply to breaker blocks. When identifying a breaker block, the candle body does not need to close above or below the recent swing point. The second rule states that in a bullish scenario, the sharp movement should create a higher high, and in a bearish scenario, it should create a lower low. This helps filter out isolated candle spikes and avoids relying on manipulated or emotionally driven moves before a market structure shift forms. The third rule highlights that once buy-side or sell-side liquidity has been taken out, the price must begin to reverse its direction. The fourth rule states that a breaker block is only considered valid if the price breaks and closes below or above the breaker block with the body of the candle. A simple penetration with a shadow or wick is not sufficient. Rule number 5 explains that breaker blocks are treated as one-time use zones. This means we focus on the trading opportunity when the price first returns to the breaker block. Once the area has been mitigated, it is no longer considered an active zone for future setups. To integrate all the criteria and rules for identifying valid breaker blocks, let us review a clear chart example. First, we have a swing high followed by a swing low. Then we see a strong upward push that breaks and closes above the previous swing high. This movement establishes a valid order block, showing strong demand. Once the buy-side liquidity is cleared, the market quickly reverses direction after forming a new higher high and begins to push downward. Eventually, the price breaks and closes below the low of the last bearish candle, confirming a clear shift in market structure. At this point, the zone becomes a valid bearish breaker block, indicating that buyers positioned in this area have been stopped out. Since the market has shown a bearish structure shift and a former demand zone has now turned into supply, we expect the price to reject this breaker block and continue moving downward. As shown, the price first pulls back upward and pauses briefly inside the breaker block. After building up additional buy orders, it gains momentum and resumes its move to the downside. Moving forward, the first high-quality type of breaker block with strong probability occurs when it forms immediately after a liquidity sweep. As mentioned earlier, a liquidity sweep is created by a single candle that clears liquidity above or below a previous high or low. This pattern often appears right before a sharp and meaningful reversal. In this situation, we anticipate a quick price reversal following the sweep. Once liquidity is cleared, the price typically returns to the area of the most recent swing low or swing high. A liquidity sweep is recognized by a candle with a long wick or body, followed by a sharp and immediate price movement that triggers a market structure shift. Looking more closely, we can see that the price has created a valid, unmitigated breaker block exactly at the location of the last buying candle. This candle formed right before a strong downward move. This breaker block meets all the criteria of an ideal setup. The price cleared sell-side liquidity, and after forming a new lower low, quickly reversed and created a market structure shift by breaking and closing above it. At this point, we can identify a valid breaker block positioned above the fair value gap. Placing an entry directly at the fair value gap might cause a missed opportunity, since the price often does not return to the gap once it moves decisively away from it. In this case, the reaction is expected to come from the breaker block rather than the fair value gap. For this reason, the entry should be placed at the highest point of the breaker block, with a stop loss positioned a few pips below the fair value gap. When planning the execution, there are two main options. The first is a single time frame entry taken directly from the current chart. The second is a more conservative approach that waits for additional confirmation. This could include looking for multiple reversal signals, such as a change of character forming on lower time frames inside the breaker block that was identified on the higher time frame. A second high-quality setup happens when a breaker block aligns with a significant liquidity void. This usually occurs when the price breaks through the breaker block with inefficiency, leaving the entire area inside a gap. This combination often produces highly reliable buy or sell opportunities. Another strong setup appears when a breaker block forms in conjunction with an order block. In this case, the order block develops near the breaker block zone. These setups are powerful because they mark areas where many orders were previously executed and where positions may still be active, increasing the probability of a retest. In this final scenario, we identify a valid breaker block paired with an order block. The entry is placed at the highest point of the breaker block, and we wait patiently for price to return and activate the trade. Identifying valid order blocks and breaker blocks helps us understand where institutions have previously entered the market. But knowing where price reacted is only part of the equation. We also need to understand where price is positioned within the current range. Within the ICT framework, one important concept quickly becomes clear. Price does not offer the same opportunity at all levels of a range, and context always matters. This observation naturally leads us to the idea of discount and premium as a way to frame price location more effectively. So, traders, what is premium and discount in the ICT methodology? And why does it matter when analyzing price inside a range? Within the ICT framework, price is not equally attractive at every level of the market. The location of price inside the range matters, especially when looking for higher probability entries and better risk-to-reward opportunities. That is where the concepts of premium and discount become important. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone. These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. The concept of premium and discount is simple, but extremely important when analyzing price within a range. It provides a structured way to evaluate where price is located in the market and helps traders identify where higher probability opportunities are more likely to form, especially when combined with proper market structure and confirmation. One of the biggest mistakes traders make is buying after price has already expanded aggressively higher, or selling after price has already collapsed lower. In many cases, traders are entering longs directly into premium, or entering shorts directly into discount, where the overall risk-to-reward profile becomes less favorable. Understanding premium and discount helps traders avoid chasing price emotionally. Instead of reacting impulsively to large market moves, traders can use the trading range to evaluate whether price is positioned at a more efficient location for execution. Once we understand whether price is in premium or discount, the next step is refining execution within that zone. This is where precision becomes important. So traders, what is OTE in the ICT methodology, and how can it help identify higher probability trade entries? OTE stands for Optimal Trade Entry. It refers to a specific Fibonacci retracement zone that aligns with discount for long trade entries and with premium for short trade entries. The idea behind OTE is to refine entry timing by focusing on areas where price is considered optimally priced within a range. It is important to note that ICT's original teachings define the OTE using the 0.62, 0.705, and 0.79 retracement levels. However, at ComLucro, we prefer to use the traditional Fibonacci retracement levels of 0.618 and 0.786, while still recognizing the importance of the 0.702 midpoint. We believe that using the classical Fibonacci levels increases confluence, since these levels are widely followed by traders across different methodologies and markets. Before applying the OTE, it is important to correctly configure the Fibonacci retracement tool. In a bullish scenario, the 0 level should be placed at the swing high and the 1 level at the swing low. In a bearish scenario, the 0 level should be placed at the swing low and the 1 level at the swing high. Regardless of how the Fibonacci is drawn, the premium zone will always be located in the upper half of the range, while the discount zone will always be located in the lower half. The position of the Fibonacci levels may change, but the concepts of premium and discount remain the same. Let us now look at a practical example of how the OTE works on a real price chart. In this example, you can see the 4-hour chart of Euro-USD. An important swing high and swing low have already been identified. From this range, we can mark out the discount and premium zones. Recall that a range is simply the distance between a swing high and a swing low. We can then plot the OTE for this same range. Notice how the OTE falls into the premium zone in this example. If price returns to this area, the focus is on observing how price reacts to each of the three levels that make up the OTE zone. As price moves forward, we can see a reaction at the 0.618 level of the OTE. While this level can be used as an entry, it is important to remember that the higher price trades into the premium zone, the greater the potential risk-reward ratio. In the next chart, price initially reacts slightly to the downside, then returns back into the OTE zone. Price closes above the midpoints but remains below the 0.786 level. On the very next candle, the market drops aggressively. Within one more candle, price reaches the swing low target. If a short trade was executed at the midpoint of the OTE, with a stop loss placed above the swing high and a target set at the swing low, this trade would have delivered a 2.4 risk-reward ratio. In the final image of this sequence, price continues moving lower after the initial target is reached. This highlights an important point. While a 2.4 risk-reward ratio is solid, there was additional downside potential that could have been captured depending on trade management. Let us now look at a long trade example using the OTE. In this case, price has just formed a swing high. We first draw the discount and premium zones, and then plot the OTE using the range defined on the chart. In the next chart, price returns into the OTE within the discount zone and reacts at the lowest level of the zone. Price touches this level without closing below it, and shortly after, price begins to move higher in the direction of the previous swing high, which represents buy-side liquidity. So, traders, market structure defines direction. Swing points reveal where liquidity rests. Liquidity drives price from one level to another. Fair value gaps and order blocks show where imbalance and institutional activity leave their mark. Discount and premium define location, and OTE refines execution. When these concepts are understood together, the market stops looking random. It becomes structured, logical, and repeatable. But even with a strong framework for structure, liquidity, and execution, traders still need a way to anticipate the most likely direction for the next trading session. This is where the concept of daily bias comes in. The daily bias is exactly what it sounds like. It is a simple way to define directional expectations for the next day, using only the previous day's high and low, and observing how price reacts when it reaches those levels. Let us start with the bullish daily bias. First, we mark the high and low of the previous day. If, on the following day, price breaks above the previous day's high and closes above it, this immediately establishes a bullish bias for the next day. Another bullish scenario occurs when price attempts to move below the previous day's low but fails to close beneath it. Even though the low is briefly taken, the inability to close lower signals a lack of selling pressure. In both situations, we can reasonably expect the next day to be bullish, or at least for the previous high to be reached. The bearish daily bias follows the same logic, but in the opposite direction. If price breaks below the previous day's low and closes below it, we have a bearish bias for the next day. Similarly, if price attempts to break above the previous day's high but fails to close higher, this also produces a bearish bias. In these cases, we can expect the next day to be bearish or at least to revisit the previous day's low. As with most trading concepts, daily bias becomes much clearer when applied to real price action. So let us now look at the daily chart of the dollar index and see how this plays out in practice. Let us begin with the current candle. The first step is to mark the high and the low. Moving to the next candle, price breaks below the previous day's low and closes beneath it, immediately establishing a bearish bias for the following day. We then update the high and low. From here, the expectation is simple. Price should either reach the previous day's low or break and close below it. As the next candles unfold, price continues to close below the prior lows, confirming the bearish bias day after day as we keep updating the highs and lows. Eventually, we reach a candle where something different happens. Price does reach the previous day's low as expected, briefly breaks below it, but then closes back inside the range. This failure to close lower changes the behavior. That single candle is enough to invalidate the bearish expectation and generate a bullish bias for the next day. At this point, we update the high and low once again. With a bullish bias in place, we expect price to either break above the previous day's high and close higher, or at least reach that level. In this case, Price does reach the previous day's high, but it fails to close above it. Even though the level was touched, the failure to close higher invalidates the bullish expectation and generates a bearish bias for the next day. With the bias now bearish, the expectation shifts to the downside. Price should at least reach the previous day's low or break and close below it. We can see that price does reach the low, but once again fails to close beyond it. This failure to close lower flips the bias back to bullish, and we update the high and low accordingly. From here, price begins to behave more cleanly in line with the bullish bias. Over the next candles, price repeatedly reaches and breaks above previous highs, closing above them and reinforcing the bullish daily bias as the highs and lows are updated. Eventually, we reach another important moment. Price reaches the previous day's high, but fails to close above it. This failure signals weakness and produces a bearish bias for the next day. When price then reaches the previous day's low and closes below it, the bearish bias is confirmed. Shortly after, price reaches the previous day's low once again, but this time it reverses strongly, forming a bullish candle that closes above the previous day's high. Notice how this reversal occurs from a fair value gap. This reaction invalidates the bearish expectation and establishes a bullish bias. As price continues to evolve, we reach a session where an inside bar forms. In this case, neither the previous day's high nor low is reached. When that happens, no valid daily bias is generated for the following day. After that pause, price closes above the previous day's high once again, restoring a bullish bias. By this point, the pattern should be clear. Across all these examples, the daily bias only fails when price does not satisfy either condition, such as during the formation of an inside bar. In the majority of cases, however, the bias aligns closely with price behavior and offers a reliable framework for directional expectation. This concept of daily bias is not limited to the daily chart. The exact same principle can be applied to intraday timeframes. Daily bias helps define directional context and can be used to guide execution and decision-making on lower timeframes as well. Directional context helps traders understand where price is more likely to move. But inside that movement, price also reacts to very specific liquidity levels formed within individual candles. Understanding how those candle ranges create liquidity leads us to another concept used in smart money analysis. This brings us to candle range theory. So traders, what exactly is candle range theory? Candle range theory, or CRT, is a trading concept built around a simple idea. Every single candlestick represents a complete trading range defined by its high and its low. When you break that candle down into lower time frames, you will notice that its high and low often act as turning points. That is not random. Those levels mark where liquidity forms. In practice, those turning points become key liquidity levels because they represent the highest and lowest price traded during that period. That period could be a day, a week, or even a 1-minute candle. In other words, CRT is not about predicting random reversals. It is about understanding how price reacts to clearly defined liquidity boundaries inside a single candle. With that foundation, we can combine this structure with smart money concepts to build high probability opportunities. Now, in its classic form, CRT works with 3 candles, and each one has a specific role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break that down step by step. Starting with the first candle, its high and low act as the primary liquidity levels that future price will often target. Since those levels represent the extremes of that trading period, they naturally attract orders and stop placements. For example, in a daily candle, the high and the low represent the absolute highest and lowest prices traded that day. That alone shows how significant those levels are. Even without analyzing lower time frames, we can identify important liquidity areas just by observing a single candle. The upper boundary is called the candle range high, or CRH. In smart money terms, the liquidity resting above this level is known as buy-side liquidity, or BSL, because it contains stop losses from short sellers and breakout buy orders. The lower boundary is called the candle range low, or CRL. In the same way, the liquidity resting below this level is referred to as sell-side liquidity, or SSL, since it includes stop losses from long positions and sell stop orders. This concept can be applied to any candle on any time frame. What matters is how price reacts to those boundaries. Now, when the second candle moves above the CRH and then quickly returns inside the range, that movement is called a liquidity sweep. In many cases, once liquidity is taken on one side, price will rotate toward the opposite side of the range. The same logic applies in reverse. If price sweeps below the CRL and closes back inside the range, it often seeks the liquidity resting near the candle range high. However, there is an important condition. If the second candle closes decisively above the CRH, the CRT setup becomes invalid. In that scenario, the market is expanding, not rejecting the range. But when the second candle fails to close above the candle range high and instead returns inside the range, we can then look to the third candle for a potential short setup, with the candle range low serving as the logical objective. That covers the core idea and the reasoning behind candle range theory. Now let's move to the concrete rules and break down how to trade it step by step on the chart. Now the first question to ask is, which candle should you choose when applying the candle range theory? If you've explored this concept before, you've probably seen that one of the most common methods among traders is to focus on the 1-hour candle formed right before the New York session opens. Why? Because the New York session often produces strong reversals, especially shortly after the open. It typically begins by sweeping liquidity built up during the London session and then shifting direction. This behavior creates excellent trading opportunities. So here's a smart and structured approach. Apply the CRT model to the 1-hour candle immediately before the New York open. If price sweeps liquidity outside that candle's range and then re-enters it, you're seeing a setup that aligns with both CRT principles and the natural characteristics of the New York session. This confluence often produces high probability setups, provided you time your entries accurately and manage risk properly. However, there's one limitation to this approach. It usually means trading against the prevailing trend. Trading in the direction of the trend gives more confidence and consistency in high probability setups. So, is it possible to use CRT while staying aligned with the trend? The answer is yes. There's a refined version of this model that applies CRT logic within trending conditions. Let's break it down. First, identify a market that's clearly trending up or down. Then, wait for a corrective move, because corrections provide both better entry prices and safer stop-loss placement. For example, if the last impulsive move started from this point and pushed all the way up to here, we expect the correction to unfold within this range. From that point, we apply the CRT model only to bearish candles. Since the overall trend is bullish, we mark the high and low of each bearish candle and observe how the next candle reacts. If the next candle breaks below and closes outside the range, the setup becomes invalid and we move on. Then, we repeat the process with the next bearish candle. This continues until we find a candle that sweeps below its low but closes back inside its range. That's when we have a valid CRT setup. At that point, we've identified both the range and the sweep. Now, the next question is, where exactly do we enter the trade? A simple approach is to open a buy position immediately after the sweep candle closes. But there's a more refined and higher precision method. We can zoom into a lower time frame to locate a more accurate entry point. For example, if we're analyzing the 1-hour chart, we can drop down to the 5-minute or 15-minute chart to see what's really happening inside that move. On the lower time frame, more structural details become visible. In this strategy, we use the fair value gaps that appear right after the sweep as our entry zones. All we need to do is wait for a fair value gap to form following the sweep and then place a buy order within that zone. Our stop loss goes just below the gap. For trade management, we can make the position risk-free by taking partial profits when the trade reaches a 1-to-1 risk-to-reward ratio. This way, even if the market later reverses and hits the stop loss, we keep our capital protected. For the remaining portion, we let profits run until price reaches a major structure level ahead. Since this is a trend continuation setup, this combination of CRT logic and fair value gap entries offers a smart and efficient way to trade candle range theory, this time fully aligned with the market's direction. Candle range theory helps us understand how liquidity forms within a single candle and how price reacts when those boundaries are swept. But in many situations, the market creates additional liquidity before the real move begins, often by attracting traders to the wrong side of the market. This is exactly where the concept of inducement comes into play. Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple terms, an inducement is a trap that encourages traders to enter too early before the real move starts. Because smart money needs liquidity, they create inducements through early breakouts, fake reversals, and misleading pullbacks. They may form order blocks that appear valid, but are not the real ones. They may fill FVGs that look like perfect entries, or create equal highs and lows that seem highly tradable. Then, once enough traders are positioned, price reverses, sweeps their stops, and moves in the intended direction. Understanding inducement is important because it helps you avoid entering too early at fake levels and liquidity traps. Instead of reacting to every apparent opportunity, you learn to wait for the true point of interest. This can dramatically improve your trading accuracy and overall win rate. At its core, inducement is the process of creating liquidity before the real move takes place. It represents the final pool of liquidity engineered to fuel the intended move, and it can appear in several different forms. The most common are structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all these variations, structural inducement is arguably the most important because it occurs directly within market structure and creates patterns that traders encounter almost every day. A structural inducement happens when price generates a false structural signal, such as a fake change of characters or a misleading break of structure, encouraging traders to enter too early or position themselves in the wrong direction. In this example, price is trending higher and continues producing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, everything initially looks completely legitimate. Price breaks above the swing high and closes beyond it. Naturally, this leads many traders to anticipate buying opportunities at the demand zone or order block responsible for that break. Then the result becomes obvious. You enter the buy position, and price quickly stops you out. This is a classic example of how structural inducement traps the majority of market participants. The reason becomes much clearer when we take a deeper look at what actually happened. This so-called break of structure was never a genuine break of structure in the first place. The entire move was driven by resting buy-side liquidity located below, inside the discount zone of the primary bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price never even retraced to the 38.2% level, let alone the 50% level of the previous impulse. This observation is extremely important. For us at ComLucro, any retracement that fails to reach at least the 38.2% level should not be considered a valid retracement. And even when price reaches only the 38.2% level, these shallow pullbacks often lead to inducements and liquidity grabs rather than clean, high-probability entries. Because of this, traders should always approach shallow retracements with caution. In a bullish trend, the preferred scenario is to wait for price to retrace toward the 50% level or even deeper, where price enters the discount zone. This is where institutional buying activity is more likely to be present and where you reduce the risk of becoming liquidity for inducement-driven moves. Understanding this concept allows you to avoid false structure breaks, identify liquidity-driven pullbacks more effectively, and remain aligned with the true direction of the market, instead of getting caught in inducement traps. Now, let's examine another chart example. Here, price is clearly trading within a bearish trend. But if you look closely, you will notice something interesting. Price breaks above and closes beyond the major swing high of the most recent bearish impulse leg. At first glance, this appears to be a bullish change of character, suggesting that the downtrend may be ending and that a bullish reversal is beginning to develop. As a result, many traders immediately begin searching for long opportunities within the fair value gaps formed during this bullish leg. Others prefer to wait for price to reach the bullish order block located at the extreme of the move. However, regardless of the entry method, traders repeatedly find themselves getting stopped out as price moves against them. The reality is that this is not a genuine change of character. It is a structural inducement specifically designed to attract buyers into the market before the real move unfolds. The reason becomes clear once we analyze the retracement more closely. If you draw a Fibonacci tool from the swing high down to the swing low, you will see that price does reach the 38.2% retracement level. However, the pullback remains very shallow. And as we discussed earlier, shallow retracements often create inducements and liquidity grabs rather than legitimate trend reversals. Because price never reaches the 50% level or retraces deeper, it never truly enters the premium zone of the previous bearish impulse. This tells us that the entire bullish move is simply a corrective pullback. Its purpose is to activate unfilled sell orders left behind during the bearish leg, while simultaneously drawing early buyers into the market. And that is exactly what unfolds in this example. Price takes the liquidity resting above the swing high, where many buyers have entered the market. That swing high itself becomes an inducement level. Price then reacts from an internal liquidity pool, represented by a fair value gap within the leg, before continuing aggressively lower in the direction of the prevailing trend. In situations like this, your focus should not be on finding buying opportunities. Instead, you should be looking for potential sell setups. Otherwise, you risk falling into the same trap repeatedly, just like countless traders do every day. This is one of the most common forms of inducement in the market, and it continues to catch traders on the wrong side of price time and time again. Now let's move on to the second type of inducement. Liquidity-based inducement is by far the most common form of inducement you will encounter in the market. It occurs when price deliberately creates a new high, a new low, or even a small order block or breaker that appears exceptionally clean, with the sole purpose of attracting traders into the wrong position, collecting liquidity, and then delivering the real move. And this process takes place every day across all markets and all time frames. The primary objective behind this behavior is to create stop losses that smart money can later use as fuel. By encouraging retail traders to position themselves on the wrong side of the market, their stops become a source of liquidity that can be collected before the true move begins. This is why you often see a small high form before a bearish move, a small low form before a rally, a false breakout before a reversal, or equal highs and lows swept by only a few pips. These events are not random. They are examples of liquidity being deliberately engineered by smart money. With that understanding, let's look at a practical chart example. In this setup, price taps into a strong daily demand zone and begins to reverse, creating a valid change of character. Based on that information, we expect price to retrace into the bullish fair value gap located within the discount area, which is where we would ideally look for buying opportunities. However, before price fully reaches the 1-hour fair value gap, something very important takes place. Price pushes lower, reacts briefly near the fair value gap, and then quickly reverses, creating a fresh lower low. That new micro low is pure inducement, and it is exactly where many traders become trapped. This minor low convinces impatient buyers that the 1-hour fair value gap has already been mitigated, and that the bullish reversal is already underway. Afraid of missing the move, they enter too early and place their stop losses directly below that micro low, unintentionally creating a clean pool of sell-side liquidity. And this is precisely what smart money wants to see. The inducement serves multiple purposes at the same time. It triggers early buyers, creates liquidity below price, makes the market appear weaker than it actually is, and traps traders who place their sell stops beneath the inducement low. All of those stop losses become the liquidity institutions need to fuel the genuine bullish move. Once sufficient liquidity has been built below price, the market dips slightly lower, sweeps the inducement low, collects those stop losses, and finally mitigates the true fair value gap, the very area institutions were targeting from the beginning. Only then does the real bullish move begin to unfold. At this stage, the liquidity has already been collected, the imbalance has been filled, and the true institutional point of interest inside the fair value gap has now been properly mitigated. However, inducement does not always appear as cleanly or as obviously as in the previous example. In some situations, rather than creating a simple micro low, price forms a fake change of character during the decline and builds equal lows directly above a small, exceptionally clean order block. At this point, three separate elements are working together. First, there is a false bullish change of character. Second, there are equal lows, which create a strong pool of liquidity filled with retail stop losses. Third, there is a fresh and very small order block formed within the change of character leg. This small order block is not the true point of interest. It exists solely as an inducement. Its purpose is to attract traders into the market too early and encourage even more premature sellers to commit before price reaches the major point of interest located below. Smart money uses this type of inducement to create additional stop losses beneath the structure, increase the amount of available liquidity needed to fuel the real move, and persuade retail traders to act on what appears to be a valid signal, when in reality, it is only a trap. At this point, you might be wondering why price needs to create an inducement before reaching the fair value gap. The explanation is actually very simple. If price moves directly into a fair value gap without first creating inducement, there is very little liquidity available. Smart money has no meaningful source of fuel to drive a strong reversal. As a result, the reaction from the fair value gap can become weak, and the setup itself may fail because there are not enough sellers available for institutions to buy from. In other words, inducement is what creates the liquidity needed to fuel the move out of the fair value gap. Without inducement, there is often not enough liquidity available to support a strong and sustained reaction from the true point of interest. Now let's look at another trading scenario. This is one of the most common inducement sequences in smart money concepts, and a pattern that appears on the charts every single day across multiple markets and timeframes. Imagine price is trending higher and approaching a significant supply zone. As it gets closer to that area, price action starts behaving in a very specific way. First, price breaks above a minor swing high. This apparent break of structure immediately attracts breakout buyers, trend followers, and traders using tight stop losses who believe the bullish move is continuing. Shortly after this breakout, the market forms equal highs or highs that are nearly equal. At this stage, another group of traders becomes trapped. Many retail traders interpret this formation as resistance and begin thinking, "This looks like a good place to short," before the move starts. As a result, these early sellers place their stop losses just above the equal highs, creating a clean and highly visible pool of liquidity. Before price reaches the true supply zone, the market often creates an additional inducement. It forms a small, very clean order block by pushing below and closing beneath the most recent higher low. With this single sequence, the market has already accomplished several objectives. It has swept the stop losses of breakout buyers. It has trapped traders who bought from the bullish breakout order block. And it has encouraged early sellers to position themselves based on the newly formed inducement order block. Then price quickly reverses and starts moving higher again. As the market pushes upward, it begins collecting even more liquidity. The stop losses of traders who sold from the inducement order block are triggered, along with the stop losses resting above the equal highs. At this stage, both sides of the market have been trapped. Buyers have been trapped, sellers have been trapped. Price action traders, breakout traders, and even some smart money traders have all been manipulated while price remains close to a major higher time frame supply zone. Only after creating and exploiting these inducement levels does price finally reach the true institutional supply zone, the area containing genuine institutional sell orders rather than retail traps. This is where smart money begins entering its actual short positions. From this point, the real bearish delivery starts to unfold, the move institutions intended from the very beginning. The lesson here is simple. If price creates a very clean micro setup immediately before reaching a major point of interest, there is a strong chance that setup is acting as inducement. Instead of entering on the inducement itself, wait for price to reach the real point of interest behind it. That is where the highest probability A+ trading opportunities are often found. Now let's move on to the third type of inducement, time-based inducement. Time-based inducement occurs when the market creates a trap move during periods of elevated trading activity, most commonly right before or immediately after a major session open. This form of inducement is particularly powerful because it appears consistently day after day and provides traders with some of the best opportunities to develop a structured trading plan while staying aligned with institutional order flow. At this point, you may be wondering why this type of inducement occurs so frequently. The answer lies in what happens during major session openings. Several important factors come together at the same time. Fresh liquidity enters the market. New order flow is injected into price almost instantly. Retail participation increases significantly, and smart money takes advantage of these conditions to manipulate price, create a misleading move, trap traders on the wrong side of the market, collect liquidity, and then deliver the true move that was planned from the beginning. Let's look at an example on the euro-dollar chart. During the London session, price trades within a relatively tight range and moves sideways for an extended period. As the New York session open approaches, pay close attention to what happens next. Right as the session opens, price makes an aggressive move to the upside, sweeping the liquidity resting above the London session high. Retail traders quickly enter long positions because price breaks above a double top formation. From their perspective, this appears to be a clean and convincing bullish breakout. However, immediately after taking the buy-side liquidity, price sharply reverses direction and drives lower, eventually sweeping the liquidity resting below the London session low as well. With this single sequence, both breakout buyers and early sellers end up getting trapped and stopped out. Once price breaks beneath the London low, many traders become convinced that the market has finally revealed its true direction. The bearish move now appears confirmed, and new sellers begin entering the market. But once again, the market reverses aggressively, collects additional liquidity, and then delivers the actual move that smart money intended from the very beginning. This entire process is a classic example of time-based inducement. Before we finish, remember that this video focused on explaining the core concepts behind smart money and ICT. It was designed to give you a clear framework for understanding how price moves, not to present a single scalping or swing trading strategy. On the channel, you will also find specific videos that explore each concept in more depth and show how they are applied in real trading strategies. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, Because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.